Coming up today, the stock market has a flash crash on the back of another Fed pivot once again. Bond yields rip higher. I look at all the market internals, and is this the start of something bigger or another buy the dip opportunity? It's a massive day, guys. Let's go. Well, there we are. Nice little rug pull going into Christmas. Classic gotcha move by the market on what's normally a low volatile and low trading period of time. And just like Warren Buffett's famous for saying, when the tide goes out, you can see he's been swimming naked. This was the worst Fed day for the S&P 500 ever. And we're now just put in the 10th consecutive down day on the Dow Jones Industrial Average. We haven't seen that for over 50 years. And this is on the back of a changing Fed once again. After they just did a huge dovish cut a couple of months ago, we just got the updated Fed dot plot showing Fed members only see on average 2 cuts next year, down from 4. And stick with me because I'll dive more into that in a minute, and we may not even get any cuts next year. The Fed could actually be done, just as I was saying yesterday, and what could be one of the fastest easing cycles we've ever seen. And so it looks like option dealers got it wrong for a change. They're mostly right most of the time. Yesterday, that VIX one day closing at 13.2. They weren't really forecasting fireworks today, but that's exactly what we got. I just had to change this to a log chart, just taking it off. Look at that, and the VIX one day, 45. That is a huge spike. We haven't seen that since the Black Monday we had in Tokyo on the 5th of August. Same with the VIX 9-day as well. Volatility shot up across the curve here. Pretty steep backwardation. 1 day, 9-day down to the VIX 30-day. Really high up the front, indicating things are likely to stay volatile going into the weekend here. However, this is what we're paid as traders to tolerate and withstand. If you own stocks, you're effectively selling volatility risk premium because you can't just expect to earn 10, 20, 30% returns a year without a few bumps in the road like this one. So this does happen from time to time. And this is what makes trading and investing hard because it's normally these moves that shakes out all the weak hands. And stick with me today because we'll run through some charts, market internals, other data and stats to see whether this could be the start of something bigger or is it another buy the dip opportunity. And so the VIX only gave us a small window to add on any hedges. I'm sure some of you guys remembered a week and a half ago, I was saying how it was a good time to buy some hedges if you're into that kind of thing. Today would have been a good day to take some profit from those hedges, and it may indeed not be over just yet either. And we did get some big moves in bond yields. There's a 2-year screaming back to 435. Still didn't make highs from last month though, but the 10-year did. Broke out above 450. That's the bond market pricing in. Things getting hotter in the economy, along with prices firming. See that with TLTs breaking down to new lows. Pretty significant move there for high yield bond. Only down 1.5%, but that's a big move for high yield bonds, just like we can see on the chart here on this volume as well. Closing at the lows. Big strong move up for the dollar as well. Gold coming off somewhat. Crude pretty much holding ground. Not much volatility in crude oil there. And it wasn't just in the States either. We got international indices selling off. One of the hardest hit, Brazil, down 6.6% today. Even a bit of profit taken in Argentina, coming off 6% as well. And we can see risk coming out of the market on the spread of high yield bonds versus treasuries here today. And a bit of an uptick in inflation expectations, but still not higher than the day after the election just yet. And again, looking at commodities versus treasuries. So markets pricing for inflation hasn't changed all that much. It's just we've seen a significant pricing in interest rates going forward that I'm about to show you in a minute. But just taking you through some of the hardest hit sectors today. ARK Innovation down 7%. That's all high beta, high value stocks coming off. And what was the hot discretionary fund had a bit of an uncoiling today as well, down 4.5%. Home builders continuing to get hit like many yield sensitive sectors today. Energy still sliding lower. Really sharp sell off these last couple of weeks. And regional banks coming off hard today as well. Bit of an unwinding of the Trump trade. That was the day after the election there. Some of these sectors and stocks getting back down to where we were trading the day before the election. Biotech also hit hard, down almost 5% today. And of course, the yield sensitive sector of REITs down 3.9%. And so we got that bearish breadth of a day. It wasn't a rotation today. And I'm pretty sure this is the lowest market breadth I've seen all year. Just looking at the percentage of stocks above the 5-day moving averages, every single sector is in single digits. In fact, some like energy, REITs, and utilities are pretty much at rock bottom. Every single stock is below their 5-day MA. Same deal on the 20 MA for those 3 sectors. All sectors have more stocks below their 50-day now, and there's only one sector that has more stocks above its 200-day than not. Financials really sticking out here. And just looking at a 15-minute chart of the SPY, pretty easy to see where we got the Fed conference trading in really low volatility environment. Then it just absolutely uncoiled. Algos hit it hard. And just looking at some of the most popular stocks out there, Apple coming off a bit over 2%, Microsoft 3.7, Amazon 4.6. Tesla had quite a sharp pullback after a monster run of late, down 8.2%. Actually, NVDA held up the best, only down 1%. And you're not going to believe it, throughout all this carnage today, quantum computing stocks still ripped up higher. Look at that, Quantum Corporation up 153%. Small little micro cap quantum stock. Another one bit bigger, 3 billion. market cap quantum computing, up another 52% today. Quick Quantum trading up again, along with D-Wave Quantum as well, but giving us a little bit of a reversal candle there potentially. And I'd say this is one of the craziest things from today. Just shows you how wild this market is at the moment. We've got huge amount of bearish breadth, massive selling, and then this hot little frothy part of the market was still ripping up today. Simply incredible. Also interesting today, one of the hardest hit stocks of late, United Health, actually gave a little bounce today. Like I was saying yesterday, might be a bit of a contrarian play here. And we can see that in the heat map really sticking out amongst a sea of red. That's just about as red as you'll see. And so this could be the capitulation event, the uncoiling, because I mean the economy and GDP, corporate earnings is still on firm footing, consumer spending still there. Market's just really recalibrating the path of interest rates going forward. However, if you listen to what Jay Powell said, he also said the economy's on firm ground, the labor market's fine. I think he's just acknowledging what we've been noticing of late, and that inflation may have indeed just bottomed out a little bit. Because just taking you through the Fed statement today, recent indicators suggest that economic activity has continued to expand at a solid pace. Labor market conditions have generally eased and the unemployment rate has moved up but remains low. Inflation has made progress towards the committee's 2% objective but remains somewhat elevated. So apparently they're still hanging on to their inflation 2% objective. Not sure if that's really realistic. They might have to recalibrate that to 2.5 or something. And just looking at their economic projections from all Fed Reserve board members, updated here today. Looking out to next year, they actually see PC inflation ticking up, but only by 0.1 to 2.5. Then they forecast it going miraculously down to 2% by 27. And they think next year the Fed funds rate will be at 3.9. Remember, we're at 4.5 now, so that's only about 2 cuts left. And just like Mohammed Al-Aran posted on X today, as shown in the Fed Reserve's latest dot plot, there is a notable dispersion in views amongst Fed officials regarding how the policy rate will evolve from here. This is part of the bigger problem, namely the consistent absence of a strategic anchoring for policy formulation. And I agree, the Fed's kind of all over the place. I mean, they just did a big dovish cut in September, saying they were worried about the labor market, kind of convinced most people were on the verge of a recession. Some people screaming out for a emergency 75 basis point cut. However, here he is today, changing his tune, and actually what could have been even worse, as he did hint today, it was actually a closer call, suggesting some Fed members may be ready to have gone on hold today. Imagine the sell-off we would have got if that were the case, if we didn't even get that cut today. May have had the Russell off 8%. So I mean, to those of us that have been following inflation, it's not all that surprising that the Fed plans to slow their rate cuts. We've been talking about this for a few months. Because Jay Powell now simply can't ignore what is definitely upside risks. We've flipped from downside risks in the economy and the labor market pretty much straight away after he cut 50 basis points to upside risks in the economy overheating, inflation come back. And again, this is something I was forecasting for the election, that Jay was going to start talking a lot more about inflation and potentially getting more hawkish after the election, no matter the outcome. He just went into it ultra dovish. Now he's flip-flopping again because he's swing trading the data month to month. Like Mohammed Al-Aran says, kind of lacking strategy and vision. And just listening to him, he doesn't seem too sure on much things either. But like we had been noting of late, inflation had made a sharp comeback ever since the Fed did cut. Trueflation had us tracking on a 1 handle. Here we are back on a 3 handle. And like he said, they may have even been doubting whether they needed to cut today or not. They have the economy tracking at 3.3% annualized themselves, and GDP growth, corporate EPS all-time highs, Mag 7 earnings still growing, healthy double digits. But like I said, it can become too much of a good thing. Things get too hot. We very well may see a breakout to the upside in inflation over the coming months. And along with that change of office, maybe these government agencies start giving us the raw data instead of revisable data that they clean up months and months down the track. Just like we saw this year when they overestimated the labor market by 30%. And we have been coming into Christmas pretty hot here on a lot of measures, like we've been talking about the last couple of weeks. Sentiment readings had been quite frothy. And just looking at seasonality in the presidential cycle, when we have a down midterm year like we did in 2022, we're following that seasonality pretty well. And that would suggest we're in for a period of maybe consolidation, weakness, and pullback, Q1 going into Q2. And I wouldn't be surprised if 2025 kind of plays out like this as well. Might not be the end of the bull market unless we get a real surprise, but it may just be a bit of a pause and consolidation in the bull market like we can often see in the third year of a bull market, because we just have had 2 back-to-back really good years. S&P up over 20% in 23, this year at 24, along with the big structural change in the global economy of tariffs. That could cause some weakness and volatility in the market that goes on for a few months. And as long as global growth doesn't fall off a cliff or no other major surprises, the market should find some support, but we still may be in for a few soft months ahead. But for the here and now, we're kind of pushing the limit on market breadth and records. S&P 500, 13 consecutive days with more declining than advancing stocks. That's only been eclipsed once before, back in 78. So if we were to have that negative market breadth again tomorrow, that would be 14. And if we did it again on Friday, that would be a new record for the most consecutive days of negative market breadth. And we are hitting some other records as well. What you're looking at here is a spread chart on the volume of up stocks versus the volume of down stocks in the NYSE at a very low 0.07 today, which we haven't seen at that low since the 5th of August. And prior to that, we have to go back a few years actually. Saw it briefly in March 23, really low there in June 22, and again in June 20. But looking back at those previous occasions, we got that really negative volume breadth. They did mark short-term bottoms in the market. There was in June 22 and March 23 was a good buy the dip opportunity there as well. Also another measure of short-term breadth, the amount of S&P 500 stocks above the 20-day average, currently at 8%, really sharp sell-off the last couple of weeks. We didn't even get that low back on the 5th of August, but we did in April 2024, October 23, and again March 23. And there's March 23, October 23, and April this year as well. That was a buy the dip. And of course, we all remember the 5th of August. That was a massive buy the dip off the open. Okay, so what's the verdict? Is this the start of something big, or is this a buy the dip? Well, like I showed you on breadth measures, we're definitely getting to extremes in terms of being oversold. A lot of the sectors are oversold as well, but S&P 500 itself, being that it's heavily weighted to mega cap tech, and them as a group actually fell 4.3% today, could still have further to go. We're still not even close to the 50-day VWAP here. Same with the Nasdaq, didn't even touch the 50-day today, and S&P could still have a bit further to go. But just looking at S&P equal weight, most stocks have been clobbered, and they are very oversold. We can see that. It's below its buy-sell band there today. Same with the Russell as well. That looks like a pretty sharp uncoiling to me. But for sure, looking at the volatility term structure, option dealers, when you can see the 1-day and 9-day higher than the VIX 30-day, that's called backwardation. So they're still forecasting a bit of volatility in the next couple of days. However, we've still got the VIX 3-month at 24. It's not all that bad. I'd say more importantly is that 10-year. If that keeps screaming towards 470, 480, or even 5, it'd be hard for the stock market, and especially those mega cap tech stocks, to ignore that. Also, we'll have to keep an eye on high yield bonds. That was a pretty sharp move there today. Didn't seem to find much support going into the close as well. So we could easily see lower prices and risky assets going into the weekend here. And like I said, even though every single sector finished lower today, some quite significantly, mind-blowing to see that frothy part of the market, quantum computing, still ripping up. Otherwise, some of the hottest parts of the market have seen some profit taking, like we saw in Tesla today. Definitely got too stretched there. So my verdict would be some of these stocks could still have further to pull back, even to come and meet their 50-day VWAP over the coming days, week or two. But some of these more old school sectors like home builders, energy, and even healthcare, like we saw with United Health today, may actually be closer to putting in a bottom than the other parts of the market, like mega cap tech and so on. And I'd say when these quantum computing stocks correct, they're going to do so magnificently, because there's obviously going to be a lot of hot money in them. And just looking at my S&P 500 oscillator, that's still not into oversold territory just yet. In fact, we've just gone below 50. And typically the market will make a short-term bottom like it did on the 5th of August. And before that, in April, when my S&P 500 oscillator goes into oversold territory. And it had actually been giving us a bearish divergence over these last couple of weeks. Along with the fear and greed index, still only in the middle of the fear zone at 34. Markets can bottom in the fear zone. However, it's more likely to make a short-term bottom when it's in the extreme fear zone. So I still think we could have a little bit further to go on the main indices. But my theory is some of these other sectors may bottom out first, especially if we get a reversal of that rotation of late into growth back into defensive sectors. Stuff like utilities and even others like energy may indeed find a bottom before the S&P and Nasdaq does itself. Because like I said, crude didn't even really come off today. It's still quite a bit above its recent lows. And like we've seen on some spread charts, also just looking at gold, even though it definitely reacts to the prospect of rates staying higher for longer, that's kind of really the theme we're dealing with here in markets today. There's a big repricing of how many cuts we're going to get next year, but like I've been saying, it's not all that surprising, and at the end of the day, it's not really a bad thing. It's just a sign the economy's growing. We don't need to stimulate. But if markets were really worried about inflation, I wouldn't expect to see a large down move in gold and some others like silver as well. But we'll also be keeping an eye on high yield spreads over treasuries. They're still really low here, below 3. If that will start to trending up again, could be signs of building stress in the market, but we're still well below 5th of August, got up to 4% there. So credit's still flowing freely. Like I said, the economy's still growing, corporate EPS is still there. And at the end of the day, the S&P 500 hasn't even done a 5% pullback off its all-time highs yet. So I wouldn't be all that surprising. Maybe see, who knows, a 6 or 7% pullback. We get down into oversold territory in the S&P, and then maybe we bounce into January, and that seasonality of consolidation plays out with the change of power in the states and the unknown of tariffs. Otherwise, like I said, this stuff happens from time to time in the market, and it's our job as traders and investors to swallow this volatility, take a long-term view, expect these things to happen, and in my opinion, they present actually good opportunities. If you've got a bit of spare cash lying around, add a few shares to your favorite positions while still have an expectation we could indeed trade lower over the next few days and week or so. But given the strength in the economy and corporate earnings, it should find support at some point over the coming days, week or so, in my opinion. Otherwise, that's a wrap today for the daily market review on this really wild day of trading, what's normally a low volatile period. We've only got Christmas a few days away. And just keep in mind, if things do get bad enough, the Fed put will always be there. Powell will be back to save the day if he has to. Otherwise, I think he's just acknowledged that the risks have flipped from the downside to the upside. And at the end of the day, like I said, it's not such a bad thing. The economy is growing to the point where they need to go on pause with their rate cuts. Thanks very much for tuning in, and I'll see you guys again this time tomorrow. Cheers.